We all know our choices have consequences. Some good, some not so good. Just ask my little kiddos. And we also know today's decisions can sometimes affect our lives for many years down the road. Just ask my grown children. Consequences apply to every part of our lives, including our finances. So let me ask you this. Are you aware that how you invest, your strategy, not just what you invest in, might cost you everything you've worked for? Hi, I'm Keith Demetriades, and today we're asking the question, are you controlling your investment decisions, or are they controlling you? You don't want to miss this conversation. We're discussing the buy and hold strategy versus the tactical investing strategy. And you really want to understand these strategies because your choice affects your entire approach to building your wealth. Let's start by discussing how each strategy works. Both of these methods hinge on time, but in different ways. Buy and hold relies on time in the market. Tactical relies on timing the market. Let me explain. Buy and hold investing is a passive, long-term investment strategy that relies on patience and consistency. Once you invest, you stay in the market regardless of what's happening, trusting that your wealth will compound and continue to grow over time. It's a relatively simple, low-maintenance approach designed for those who want to build wealth without making constant adjustments. The consistency of buy and hold is its key strength because its stay-the-course nature can help reduce the risk of emotional decision-making and ensure you're taking advantage of critical growth periods. Tactical investing takes a more hands-on approach. Instead of staying put, you make active decisions about when to enter or exit the market, aiming to take advantage of short-term trends or potentially avoid big losses. This method requires sharp timing and analysis, getting in at the right moment and out before trouble hits. Done well, it can yield significant rewards. Tactical investing suits investors who are confident in making frequent, calculated moves. It comes with the potential for higher rewards, but it does carry higher risks. So that poses a key question. Do you want the steady confidence of knowing time is on your side, or the thrill of navigating market opportunities as they arise? The answer shapes both the contents of your portfolio and how you engage with your investments and potential opportunities. Let's talk about how that works. Historically, buy and hold has been a pretty safe bet. Take a look at this chart from Fidelity, which really drives that point home. Imagine this, January 1980, you invested $10,000 in the S&P 500 index. If you stayed entirely invested through the end of December of 22, your investment could have grown to over $1 million. How is that, Keith? Over that 43 period, the market trended upward reliably, and that $10,000 just kept compounding. The numbers show you the power of time in the market, staying invested over the long term. But here's where it really gets interesting. We know that tactical investing involves timing the market, which means exiting and re-entering the market at key moments. If you do it right, it can mean big gains, no question. But let's also talk about the potential downside of dipping in and out. Because if you don't get that timing just right, it could have major long-term consequences. Going back to the chart, the data is pretty clear. In this scenario, if you miss just the top 5 performing days during this 43-year period, your investment would have only grown to about $670,000. That's a loss of over $400,000 compared to staying fully invested. If you missed the top 10 days, it would have grown to $480,000, a loss of $600,000 compared to staying fully invested. And if you missed the best 30 days, your investment drops to $170,000, which means you forfeited $900,000. And finally, missing the top 50 days leaves you with just $75,000, a loss of $1 million. Now think about what that really means. This 43-year stretch containing more than 15,700 days, if you had 5 days, that represents the tiniest fraction of the overall total. But being out of the market for just those 5 days could have cost you nearly half of your returns. It's crazy. Here's the critical lesson. The market's most significant gains often occur during brief, unpredictable periods. Attempting to time the market can lead to missing pivotal days. And the success of the buy and hold isn't just theoretical. It's backed by decades of market performance. Remember, The S&P 500 reflects the largest and most influential companies in the U.S. And its history proves that while the market can be unpredictable in the short term, it trends upward over time. Staying invested ensures you capture the recovery periods that follow downturns and the remarkable growth, especially present at the birth of the bull market. Knowing that, why would you ever even want to consider tactical investing? Again, the fundamental premise for buy and hold is to drop your money in and then walk away. Leave it alone. You have to do it knowing you're in for a roller coaster ride, and there will be exhilarating highs and demoralizing lows. And you have to stay the course, regardless. This philosophy can get very painful when you take losses, especially with a larger portfolio. If you have $100,000 in the market, you take a loss of 30%, you're down $30,000. But if you have a $10 million portfolio, that same downturn means a loss of $3 million. Are you prepared for that? Can you separate yourself, your emotions, from your money? Money is, by its nature, emotional. It's tied to years of blood, sweat, and tears, moments of success, sacrifice, and a lifetime's worth of history. It's natural to hate watching that money disappear during a downturn. On the flip side, it's thrilling to watch it grow rapidly. That's why many investors opt for a tactical approach. They want to feel they have some control over their gains and losses. Many investors tell me, I like the idea of immediate big wins, and I want to be able to avoid the big losses. Deciding when to be in or out of the market means my results come from my own choices instead of being completely dictated by market shifts. The idea of big losses is a major consideration, especially for those in retirement, because your investment timelines are shorter and you're also taking withdrawals. A 15 to 20% drop might be manageable, but what about a 40% drop? Something that big would likely take 6 to 7 years to recover, more time than most retirees can afford. It's something to think about. And since we talked about what being out of the market on the best days could mean for your returns, let's also look at what being out of the market on the worst days could mean. Here's another chart. This one from the American Association of Individual Investors. It shows the complete story. It shows S&P performance from January 3rd of 2000 to December 31st of 2019. Again, we see the impact that actually takes effect on just a $10,000 portfolio. So if you can be in for the wins and out for the losses, it can have a major impact on your portfolio. However, remember that this method requires very precise timing. Highs and lows often occur in very close proximity within days of each other. You have to get the timing just right. And tactical investing shouldn't be haphazard guesswork. You should consider how you're going to make those tactical choices. And you still want to avoid reacting emotionally. That's never a good bet. So it's wise to create guidelines in advance. Tactical strategy relies heavily on your choice of indicators. Let me explain what I mean by that. You can make strategic choices, but you need to understand the metric you're adhering to and why. Jumping back and forth between different metrics can be contradictory and ultimately work against you. For example, tactical indicators can fall into 8 different categories, each of which can be drilled down even further. You should also consider how an indicator in one category might impact those in others. Those categories for indicators could be economic, market sentiment, technical indicators, valuation metric, sector and asset class, monetary, fiscal policy, behavioral metrics, global indicators. If the thought of leveraging indicators intrigues you, there's one more thing I want to share about tactical investing. There are 5 distinct steps you'll need to take for this method to be effective for you. Here's what that looks like. The first, develop a reliable indicator for short-term market returns. The foundation of tactical investing is understanding where the market might be headed in the short term. This requires a reliable indicator, whether that's a technical signal, a market trend, or some other economic data point. Obviously, you're not predicting the future, but you are making informed decisions based on consistent patterns and analysis. The second, time your exit with precision. Knowing when to step out of a position is essential. Markets are dynamic, and timing your exit to the day ensures you lock in gains or minimize losses. It shouldn't be guesswork. You'll want a process that guides your decisions while accounting for potential risks. The third, time your re-entry with equal precision. Exiting is only half the game. Re-entering the market at the right time is just as important. This means recognizing when the market is poised for growth. You're kind of threading the needle, but a disciplined approach can help make it a manageable task. The fourth, determine your allocation. Tactical investing doesn't necessarily mean putting your entire portfolio in play. Deciding what percentage of your account to allocate to tactical moves is key. This step ensures your overall strategy remains balanced, allowing you to pursue opportunities without overexposing yourself to risk. And the fifth, execute the trade. Once your plan is in place, execution is everything. Markets can move quickly, and being ready to act ensures your strategy stays on track. Whether through automated tools or disciplined manual trading, precision here can make all the difference. You can see that tactical investing tends to be much more complex and can be challenging, even for trained professionals. Now, this is obviously a more complex process. So is it really worth considering? In one word, yes. Tactical can be very useful in certain circumstances. For example, when markets are volatile or uncertain, tactical investing provides agility and lets you take advantage of sudden price swings or step back when risks escalate. Similarly, as the economy moves through cycles of growth, stagnation, or even recession, tactical investing lets you adjust towards sectors that thrive in specific conditions, such as defensive stocks during a downturn or cyclical sectors during periods of expansion. And sometimes opportunities arise within specific sectors or asset classes like renewable energy during a push towards sustainability or commodities during inflationary periods. Tactical investing helps you position your portfolio to capitalize on those trends. It can also be effective when central banks adjust interest rates because you can adapt and reduce your exposure to rate-sensitive investments or shift toward alternatives that align with the new environment. Also, if you have short or medium-term goals, like saving for a major purchase or preparing for a life transition, tactical investing can help align your portfolio with those objectives because it's a more flexible approach. And finally, done correctly, tactical investing can help manage risk because you can move towards safer assets like bonds or cash, commodities, options, when markets show signs of stress. So there is clearly an argument for both sides. But how do you choose? The good news is you can use both methods, and I consider this the best approach. Here's how it might look. Let's say Carol is a 58-year-old investor with $1 million portfolio. She's preparing for retirement and has 80%, $800,000 of her investments designated as buy and hold. They stay put, they grow steadily over the long term, they're in for the ride. However, Carol also knows there are times when it pays to be more flexible. So she keeps $200,000 available for tactical investing to handle specific opportunities or risks. Most of Carol's money is in diversified investments like index funds and bonds. These sit untouched because she believes the market will follow historical trends and her retirement savings will grow steadily over time. But let's imagine inflation starts rising. So she moves a small portion of her tactical funds into investments that can handle inflation better, like Treasury inflation protected securities, TIPS. And maybe the tech sector shows strong growth. So Carol uses part of her tactical funds to buy into a tech-focused investment, aiming to capture some short-term gains. After a year of solid stock market performance, Carol might move some of that money back into bonds to keep her portfolio balanced and reduce risk if she's seen a significant gain. That's a tactical cycle that can potentially reap rewards. Now, this might not be the way this goes. That $200,000 being tactically invested might do nothing or even take a loss. As with all investments, there's no lightning in a bottle. There is no perfect investment, and there is always a risk-reward relationship to consider. But either way, many folks find they have a greater peace of mind just knowing they have some degree of control over their investments. Ultimately, both strategies have benefits, and they can complement each other very well. Finally, I just want to mention that while buy and hold is considered a passive strategy, it should never be laissez-faire. While it doesn't require as many immediate decisions as tactical investing, it still requires focus and consideration. You should expect to work with your financial advisor to make appropriate adjustments along the way. And regardless of the method you choose, it can't be overstated enough that the key to success with either approach is to have a disciplined and a consistent process. A good financial advisor can offer invaluable, clear, objective, and non-emotional advice to keep you on your path. I'm Keith Demetriades. If you found this information helpful, like the video, share it with someone who might benefit, and subscribe for more practical strategies to help you manage your wealth with confidence and purpose. And remember, be a savvy steward. Make your life count.